So imagine a company that essentially has like one primary function, just one massive engine that drives its entire valuation.
Right.
And for years, this engine has been running at absolute maximum capacity, basically dictating the movements of an entire global market.
Yeah, completely driving it.
But then, out of nowhere, the CEO just walks out onto the factory floor and unplugs the machine. He just announces they're taking a week-long vacation.
Which is crazy when you think about it.
Right. You would naturally expect the market attached to that machine to just stall out or even crash. But instead, the moment the machine powers down, the market surges 20%.
It completely defies basic market expectations because when the dominant player removes their buying pressure, prices are supposed to fall. That's just economics.
Which is exactly what makes today's financial landscape incredibly fascinating to unpack. So for everyone listening, today's Monday, May 4, 2026.
Yep.
And Bitcoin is hovering right near the $80,000 mark, which represents its highest level in, what, 3 months?
Right around 3 months, yeah.
Right, so it's been making this really aggressive recovery from the correction we saw after it hit its all-time high of roughly $125,000 back in October of 2025.
Exactly.
But the headline everyone is focused on right now is that 20% climb over the last 30 days. And, the actual story, the structural mystery we're diving into today is who was noticeably absent while the market was climbing.
Yeah, the elephant in the room, basically. The market's absolute biggest buyer took a step back, and rather than collapsing, the broader ecosystem simply absorbed the absence and just, pushed higher.
It's like the biggest kid suddenly getting off a seesaw, but instead of the other side crashing down, the seesaw somehow goes higher.
That's a great way to look at it.
So to really understand the mechanics behind this anomaly, our mission for this deep dive is to decode this complex financial machinery.
And we have a great stack of sources for this. We're looking at specific corporate financial data, recent executive tweets, Wall Street analyst reports, and even some very revealing academic research from the Journal of Risk and Financial Management from back in 2023.
Right, but before we get into the macro implications of all that, we really need to define the sheer scale of the player we're talking about here. We're looking at the company formerly known as MicroStrategy, which now operates simply as Strategy.
Yeah, and to call them a whale is almost like an understatement at this point.
Oh, totally.
They are the apex predator of this specific asset class. Strategy currently holds 818,334 Bitcoin on their balance sheet.
Which, just to put that into perspective for you guys listening, that single corporate entity owns nearly 3.9% of the total supply of Bitcoin that will ever exist.
Yeah, it's staggering. And their capital commitment is just massive. Their total investment exceeds $61.8 billion, with an average purchase price sitting at roughly $75,500 per coin.
Wow.
So at today's $80,000 price tag, they are sitting on billions in unrealized profit. But the thing is, they have absolutely no intention of stopping.
Right, they've been super clear about that.
Exactly. Their publicly stated corporate goal is to acquire 1 million Bitcoin by the end of 2026. So to hit that target by December, they still need to purchase roughly 180,000 more coins.
So they were essentially this, corporate machine built exclusively to accumulate this one asset.
Pretty much.
Which brings us to the bizarre catalyst for our discussion today. Because over the weekend, Strategy's executive chairman, Michael Saylor, published this staggeringly blunt 9-word post on X.
Oh, yeah, I saw that.
He literally just wrote, "No buys this week. Back to work next week."
And that brevity just sent shockwaves through the analyst community because of how incredibly rare an operational pause like that is for this company.
Right.
If you look back at their purchasing cadence throughout 2025 and early 2026, they are relentless. They acquire Bitcoin almost weekly.
Yeah, it's nonstop.
So this specific announcement marks only the second time in that entire multi-year stretch that they have paused. The only other brief window was in late March.
Which immediately raises a psychological question, If a machine designed to buy suddenly stops buying the moment an asset hits a major psychological threshold like $80,000, the easiest assumption is that they're getting nervous.
Oh, for sure.
Right, human nature would suggest they looked at the price tag, decided the market was maybe overheated, and decided to wait for a dip. So is that what's happening? Are they anxious about the price?
Well, market anxiety is the natural conclusion from the outside looking in. But when we overlay Strategy's corporate calendar with standard financial reporting practices, a completely different narrative emerges.
Okay, so it's not about the price.
Not at all. The pause has absolutely nothing to do with the philosophical shift on Bitcoin's value, and literally everything to do with the logistical friction of corporate accounting.
Oh, really? Let's drill into those mechanics because tomorrow, Tuesday, May 5th, Strategy is scheduled to release its first quarter 2026 earnings report after the closing bell.
Right, and this is where the concept of mark-to-market accounting becomes the primary driver of their behavior.
Break that down for us.
Yeah, so under current accounting standards, a company holding digital assets like Bitcoin must report the value of those holdings at the current market price at the very end of their financial reporting period.
Okay, so unlike a piece of commercial real estate where you only record a gain or a loss when you actually sell the building,
Exactly.
Strategy's balance sheet is violently expanding and contracting in real time alongside Bitcoin's daily volatility.
Yes, that is the core issue right there. Every single price fluctuation creates an unrealized gain or an unrealized loss that flows directly into their financial statements. Now, put yourself in the shoes of their chief financial officer. You're trying to finalize these really complex quarterly books to present to Wall Street regulators and investors.
Sounds like a nightmare.
It is. And if the purchasing department is out actively acquiring thousands of highly volatile coins in the final hours before the quarter closes, they are introducing massive chaotic variables into the ledger.
Oh, I see. Because the math is constantly moving while the accounting team is trying to lock the final numbers in place.
Exactly.
So taking a week off isn't a sign of weakness. It's just an administrative freeze to let the dust settle so they can actually publish a coherent earnings report.
That's all it is. It's a purely tactical pause. But exploring their earnings report reveals this really fundamental paradox about what this company actually is in the year 2026.
Yeah, and that paradox is glaring when you look at the Wall Street projections for tomorrow's call. Because on paper, Strategy is still an enterprise software company.
Right, technically.
And analysts expect that legacy software business to generate between $120 to $125 million in revenue for the quarter. But simultaneously, the consensus projection is an $18.98 loss per share.
Yeah, which is, for a traditional technology company, a nearly $19 loss per share alongside stagnant revenue would be a catastrophic death spiral.
Oh, completely. It's like, imagine a neighborhood bakery where the owner is up at dawn baking sourdough. The bread sales bring in enough cash to keep the lights on, maybe even operating at a slight loss.
Right.
But in the back room of his bakery, the owner has installed a massive vault containing billions of dollars in solid gold bars.
I love this analogy.
And not only that, but the owner's constantly using the bakery's business credit to take out massive loans to buy more gold to stuff into the vault. No one buying stock in that bakery cares about the profit margins on a loaf of sourdough.
Exactly. And that analogy perfectly captures Wall Street's current valuation model. Investors are treating Strategy as a leveraged Bitcoin financing vehicle.
It's all about the gold in the vault.
Yep. The massive projected loss per share is driven almost entirely by the mark-to-market accounting of their Bitcoin treasury and the hefty costs of the capital they are constantly borrowing to acquire it.
Which opens up a much deeper rabbit hole for us to explore. Because if they're basically functioning as a financing vehicle to buy the gold in the back room, we have to examine the actual financial engineering they use to raise that capital.
Yes, and that brings us to a specific instrument that has really fractured the financial community into two incredibly polarized camps.
The STRC.
Right, the STRC. So the STRC is Strategy's perpetual preferred stock offering. Mechanically, a perpetual preferred stock acts as a hybrid between a traditional stock and a bond.
Okay.
It trades on an exchange, generally targeting a price near $100 a share, but it carries an obligation to pay out a yield to the people holding it.
And the yield on the STRC is what makes it so aggressive, right?
Yeah.
Like it currently offers a variable monthly dividend that annualizes out to approximately 11.5%.
Yeah, 11.5.
Which is wild. Because in a world where traditional savings accounts or municipal bonds might yield, 4 or 5%, offering investors a near 12% return is a massive magnet for capital.
Huge. Strategy takes the hundreds of millions of dollars raised from selling these STRC shares and immediately converts that cash into more Bitcoin.
Right.
But this structure is exactly where heavy criticism from traditional finance intersects with really aggressive praise from modern analysts. And we need to evaluate the mechanics of both arguments to see the full picture here.
Yeah, absolutely. And we want to present both sides fairly for you guys listening. So let's start by walking through the structural critique. Analysts like Vedal Lunde from K33 are raising serious red flags about systemic risk.
They are.
The core mechanical problem they point out is the nature of the underlying asset. Bitcoin just sits in a digital wallet. It does not produce cash flow, it doesn't generate rent, and it doesn't pay a native yield.
Which means Strategy is taking on an ironclad obligation to pay out an 11.5% cash yield to their STRC investors, using an asset that generates zero native cash to fund that payment.
Right, so how do they actually manage that mechanically? I mean, if the vault in the back room doesn't generate cash, where do the dividend checks actually come from?
They essentially have to manufacture the yield.
Okay.
They do this by relying on capital appreciation. So if the price of Bitcoin consistently rises by more than the 11.5% they owe, Strategy can leverage their appreciated balance sheet to issue new debt, sell more shares, or theoretically liquidate tiny fractions of their holdings at a massive profit to cover those dividend obligations.
Oh, wow. And that specific mechanism is what caught the attention of longtime financial commentator Peter Schiff.
Right, Peter Schiff has been very vocal about this.
Yeah, he argues that this structure exhibits Ponzi-like characteristics. And his underlying logic is that the entire STRC instrument fundamentally relies on an endless influx of new capital and perpetual price appreciation. Like, if the price of Bitcoin stalls or drops significantly, the underlying math supporting that massive dividend payout just collapses.
Yeah, Schiff used it as a structural house of cards tied entirely to positive market sentiment.
Right.
But flipping to the other side of the debate, major institutional players look at the exact same 11.5% obligation and views it as a brilliant innovation.
Yeah, the Wall Street consensus is overwhelmingly positive. TipRanks currently aggregates the analyst ratings as a strong buy. And we also have firms like ClearStreet, who recently evaluated the STRC structure and responded by bumping their price target for Strategy up by 18%.
Yeah, projecting a target of $233 a share.
Right. So the institutional supporters argue that Strategy has successfully engineered a legal framework to monetize the historical volatility and upward trajectory of a scarce digital asset.
It's pretty clever from their perspective. They are offering traditional income investors, like people who manage pension funds or retirement accounts, and absolutely demand yield a way to get exposure to Bitcoin's massive upside without having to actually hold the raw asset.
Oh, I see. So basically, by offering that 11.5% yield, Strategy acts as a vacuum, sucking up billions in traditional yield-hungry capital, and then channeling it directly into buying raw Bitcoin.
Exactly.
And then that buying pressure inherently drives the price of Bitcoin up, which then secures their balance sheet and validates the STRC offering.
Yes, it creates this self-reinforcing feedback loop of capital. So really, the genius, or the catastrophic danger, depending on who you ask, of this entire multi-billion-dollar corporate apparatus hinges on a single external variable.
The future price trajectory of Bitcoin.
Precisely.
Which brings us full circle to the events of this week. Because the biggest buyer, the company driving that self-reinforcing loop, explicitly stated they were stepping away from the market for a week.
Right. And if the critics are correct, and Strategy is the only thing artificially propping up the market with their STRC capital loop, then Saylor taking a vacation should have caused the price to immediately retrace.
But it didn't. The price surged 20% and hit $80,000 anyway.
Yeah.
So, to explain why the broader market absorbed the shock so easily, we have to pivot and look at the academic data regarding market dominance.
Yeah, and a really great starting point for this is Eugene Fama's efficient market hypothesis.
Oh, the 1970 theory.
Right. It's a foundational theory from 1970 that essentially states that in a perfectly liquid market, all known information is instantly reflected in the asset's price.
Got it. But that theory assumes a decentralized pool of buyers and sellers, right? Like in a massive market like the S&P 500, no single entity possesses enough capital to arbitrarily dictate the price of the entire index for a sustained period.
Yeah.
The market is just too vast.
Exactly. However, historical data shows that Bitcoin has operated very differently. The supply distribution is heavily concentrated. Research indicates that roughly 2% of anonymous wallets hold an astonishing 92% of the total Bitcoin supply.
Wow, 2% holds 92%. So when supply is that concentrated, Fama's theory just fractures. A single massive entity like a whale can execute a trade so large that it actually overwhelms natural market discovery.
We have empirical evidence of this, actually, from a 2023 study published in the Journal of Risk and Financial Management by a researcher named Ante.
Yeah, the methodology of this study is fascinating. Ante didn't just look at broad market trends. He isolated the specific windows of time around strategies' public purchasing announcements.
Right, he was looking for abnormal returns.
Exactly. Price spikes that statistically deviate from the broader market behavior and can really only be explained by one specific catalyst.
And he found them. The study concluded that historically, strategies' buy announcements triggered statistically significant short-term price spikes across the entire Bitcoin ecosystem.
So they were not merely participating in market discovery.
No, they were the ultimate price maker. The sheer volume of their acquisitions forced the market to bend to their activity.
Okay, so let's apply that 2023 data to May of 2026. If the ultimate price maker announces they're shutting down operations for a week, historical precedent dictates the market should just flatline.
Right.
So the fact that Bitcoin climbed 20% in their absence is a glaring signal that the underlying structure of the market has somehow mutated.
It really points to a profound maturation in market liquidity. The demand curve is no longer resting entirely on the shoulders of one single corporate balance sheet.
Wait, if strategy's pause didn't crater the market, that means the ecosystem has built a completely new baseline of demand. Who is stepping in to absorb that supply?
Well, the diversification of demand really accelerated after January 2024, when spot Bitcoin ETFs were finally approved in the United States.
Ah, right, the ETFs. The mechanics of those really changed the plumbing of the financial system. Because before 2024, a registered investment advisor managing, say, a family office or a pension fund couldn't legally custody raw Bitcoin on a crypto exchange due to strict compliance rules.
Exactly. The ETF wrapped the digital asset in a traditional, highly regulated financial wrapper. It basically trades on the New York Stock Exchange just like a share of Apple.
Which unlocked trillions of dollars in sidelined institutional capital.
Yeah, creating a highly diversified, decentralized layer of continuous buying pressure from thousands of different financial advisors who are allocating tiny percentages of their clients' portfolios.
And beyond just the ETFs, corporate adoption has evolved from a novelty into a standardized treasury strategy. Like, we saw a major inflection point at the Bitcoin for Corporations event held in Orlando back in May of 2025.
Oh yeah, that gathering was a pivotal moment for institutional infrastructure. 38 major corporations attended, representing 69% of all global corporate Bitcoin holdings.
That's huge.
And their collective agenda was to establish standardized protocols to accelerate corporate adoption by the year 2030.
So strategy might have been the pioneer, proving that a publicly traded company could use a digital asset to defend its balance sheet against inflation. But that conference proved they're no longer an isolated outlier. There is this rapidly expanding coalition of corporate treasurers actively executing the exact same playbook.
That is the fundamental transition we are witnessing right now. The ecosystem has evolved. Bitcoin is migrating from a volatile, retail-driven speculative token into a premier institutional-grade reserve asset.
So when Michael Saylor tweeted that his buying machine was taking a geek off, the market barely blinked.
Yeah.
Because it has developed the institutional muscle density to just stand on its own.
Exactly. The pause effectively acted as an accidental stress test for the entire asset class. And the market passed.
It totally passed.
The underlying infrastructure, the ETFs, the diversified corporate treasuries, the family offices, they all demonstrated that they can support and even drive massive price action independently of their largest historical whale.
It is a remarkable shift, really, from the 2023 academic models, where one company dictated the whole narrative, to this resilient global market that just marches upward on its own momentum.
It really is.
But, exploring the depths of this financial engineering leaves us with a critical, lingering variable to consider for everyone listening.
Yeah, specifically regarding the structural mechanics of that STRC preferred stock we were talking about.
Right. We established that Strategy's model functions flawlessly in our current environment. The price is pushing $80,000, the ETFs are absorbing supply, and capital appreciation easily covers that 11.5% dividend obligation.
Sure.
But I want you to imagine a scenario where the macroeconomic environment sharply pivots.
Like a scenario where the self-reinforcing loop is tested by external forces.
Exactly. Consider the regulatory risk. What happens if the U.S. Congress suddenly intervenes and determines that a single corporation holding nearly 4% of a global monetary network represents an extreme supply concentration risk.
That would change everything.
Right. Imagine regulators place a hard cap on corporate holdings, forcing strategy to stop buying, right at the onset of a brutal multi-year bear market.
Oh man, a bear market where Bitcoin's price stagnates or drops, failing to provide the capital appreciation required to fund their massive yield obligations.
Yes, because if the underlying asset isn't appreciating, and they are legally bound to pay out hundreds of millions in dividends to STRC holders, they would be forced to begin aggressively liquidating their massive Bitcoin reserves just to service their own financial engineering.
And unwinding an 800,000 coin position into a weak market would create a catastrophic supply shock.
Exactly. The very financial instruments designed to suck capital in and drive the price to all-time highs could become the exact mechanism that violently drains liquidity out of the entire ecosystem. If the biggest player in the market is forced to drop their entire weight onto the way out, the resilience of those new institutional floors will be truly tested. Something for you to ponder. Keep questioning the mechanics behind the money, and we will see you on the next deep dive.